Welcome to EverThrive Financial's 5 Things Investors Need to Know This Month. I'm Valerie Leonard, CEO and founder of EverThrive, and let's jump right in and get started with number 1. First, you need to know that the economy expanded better than we expected for the third quarter. We saw GDP growth at an annualized 4.9% rate. We also saw personal spending up about 4%. And this is especially notable since interest rates have been near their highest levels in 22 years. That's no news to you, but this is good news. It's just important to note that we want to see where the growth is coming from and make sure it's sustainable. So as a fun fact, you may have heard that Beyonce concert tickets and Taylor Swift concert tickets, and yes, even the Barbie movie, have added billions of dollars to the economy, and this is true. But on a more serious note, though, a big portion of third quarter GDP came from consumption, and the pace at which we've seen personal disposable income and also the savings rate change, we're not seeing that keep pace with the level that consumers are spending. So in other words, some of this growth is fueled by people drawing down their savings, or maybe they're just spending beyond their means. And that's not sustainable from a long-term growth standpoint. So we're going to continue to watch this growth path. Also know that government spending was also a significant contributor to third quarter GDP results, which is also generally not sustainable. So this is something we'll keep an eye on as well. Second, let's take a look at markets during periods of war as we continue to send our sympathies to regions of conflict throughout the world. Last year, I received a lot of questions around the impact of the war in Ukraine, and now I'm getting similar questions about the news of escalated conflict in Israel and in Palestine. Now, the Bureau of Labor Statistics shows that market values at the end of World War I, at the end of World War II, the Vietnam War, and even the period of time after 9/11 were equal with or even higher than values at the beginning of those conflicts. So while these examples feature wars in which the United States was directly involved, the same principle generally holds true, and that is that stock markets get rattled by initial wartime uncertainty, but history shows us how resilient markets can be even in the midst of conflict. Third, I want to talk a little bit about headline inflation versus core inflation. Now, headline inflation includes commodities, things like food and energy, but core inflation strips those out. It excludes food, it excludes energy prices, primarily because their prices can be so volatile. Headline inflation has been falling recently, like it did in the 1970s, but core inflation is not. And this means it's tougher to get inflation under control, especially with GDP results that have been better than expected. So while the Fed has signaled that they're pausing their interest rate hikes, keeping inflation in check is one of their mandatory mandates. So if we don't see core inflation come down, they may be forced to start raising rates again. Only time will tell us whether or not that will be necessary, though. Fourth, what happens historically after the Federal Reserve pauses rate hikes? Typically, we see mixed results. The chart on the left shows the S&P 500's performance 12 months prior to and 12 months after the Fed pause. The chart on the right shows the same for the 10-year U.S. Treasury. Now, let me remind you that the past doesn't guarantee future results, but it wouldn't be out of the question to see a rally in the bond market after all of the price pressure that bonds have experienced the past few years. What's interesting is there have been periods of time where the market rallied following the end of a sudden and steep rate hike period. Specifically, the Fed raised rates by 3% in 1994, and then they followed up with 3 rate cuts. So the market may be signaling today a similar scenario now. In that case, the S&P 500 moved higher by about 37% in 1995. So again, this is not a prediction. It's just one out of many historical references that may be worth considering. And last but not least, we're on track to end 2023 on a strong note with the S&P 500 up 21% as of November 30th. And the volatility that we have seen has been normal. keep in mind that the performance of a diversified portfolio may not have been as strong this year because we've really only seen a few asset classes that have experienced significant growth. But do know that a diversified portfolio still remains one of the best ways to invest. Keep in mind you have choices, and if the market and the economic swings are keeping you up at night, let's revisit your risk tolerance and review your options. Having said that, we are maintaining cautious optimism for the path ahead. If this information has been helpful to you, don't forget to subscribe to our YouTube channel or look EverThrive Financial Group up on social media. All of us here at EverThrive wish you the happiest of holidays, a Merry Christmas, and a wonderful start to 2024.